Employee compensation tax planning. So this is as it relates to stock. If you're working for a company that is a publicly traded company, many times a lot of the bonuses are going to flow through in the form of stock. That's known as a restricted stock unit. So the key item to be aware of there is that it's going to be taxed as ordinary income. Kevin, why don't you talk a little bit more about RSUs and what we often see as a unknown side effect as it relates to tax associated with restricted stock units?
Yeah, so one of the big things with RSUs, and we have a lot of clients who are receiving this, is it's going to be effectively taxed at 22% withholding. And some of our clients, again, are getting taxed at higher rates than that. So when April comes of each year, they're paying this big tax bill. So there's a few different items that you can be thinking about. If the stock does really well, typically clients are okay, or they have the additional dollars to spend to pay the tax bill. But there's years where that RSU, because it's taxed as ordinary income, sometimes the stock, has a significant drop in a certain year, and now you're still paying tax on maybe it was $100,000 in RSUs you got, but now that stock has went down 30, 40%. Now it's $60,000, essentially your effective amount, but you're still paying tax on $100,000 of income. Right. So again, it's something to be thinking about is what to be doing if you should be making quarterly tax payments, or there's way you can have your W-4 to essentially withhold additional dollars. But again, it's conversations we're having in advance versus, again, because you don't want to also at the same time overpay the IRS, because essentially if you're doing that, you're missing out on additional dollars you can invest, live on an annual basis. So again, it's measuring what your tax forecast is on an annual basis.
What I always kind of utilize to kind of help clients understand restricted stock units is they're really cash bonuses just in the form of stock. The company is giving you, say, $50,000 worth of shares. It's taxed to you just like getting $50,000 of a cash bonus. However, you're given the stock, it's on you to then diversify the position. And many individuals I see either do one of two things. They sell it immediately, convert it to cash, and then utilize those funds, or more often than not, they do nothing, and the stock continues to pile up. That could be extremely lucrative and beneficial if the stock's doing well, but it's very difficult for single stocks to outperform the market on a consistent basis. So many times that stock can underperform, and just to Kevin's point, you've received the shares. Had you sold them and then maybe diversified, that could have been a better risk versus return strategy for you. So the key consideration is restricted stock units are taxed as income. You're then given that stock, and your cost basis is the day the stock vested. From there, the stock can go up and it can go down. The next sale is either going to trigger a capital loss or a capital gain. We'll get more into capital gains and losses and potential strategies later. What about employee stock purchase plans? What can you talk to us in the audience about employee stock purchase plans, and when should employees consider that?
Really what the appeal is, especially when someone first joins a company, is they're like, well, I get every single position 15% off. Essentially, if you're buying the stock at a 15% discount, the attractive piece of that is you are dollar cost averaging, and that means you on your bi-weekly paycheck that you are buying the stock at different price points, which is again a benefit. But what people start to do is they're getting the RSUs, they're getting employee stock purchase plans. Now they're at the company for 10, 15 years. Now 50% of their wealth is in one concentrated stock. So on a month-to-month basis, their total net worth is now heavily concentrated in one position. So again, it's a good strategy, but also one to be mindful of how much you're doing and what that starts to look like over time. At what point is it beneficial if the stock goes on a run to potentially sell some of that employee stock purchase plan that you did well on for the last few years buying it, and start to look to diversify and have more predictable returns and overall diversified portfolio.
So the key point here with equity compensation is be aware of what tax impact those shares are having on you in the restricted stock side, but then also be aware of the concentration. Employee stock purchase plan, it's amazing. You can buy the stock at a 15% discount. Everybody loves buying something on sale. Just be careful of how much you're going to hold of that company stock and what risk you're placing now with the company being your employer, but then also potentially being your largest position. Where we also see a lot of over concentration sneak up on our clients is going to be with stock options. And we can get very much into the weeds on stock options. I want to keep it high level here. What's more uncommon, which is typically going to be for companies that are a little bit younger in nature, more in the startup phase, or they just recently went public, would be incentive stock options. These are really, really special, but we've seen a ton of mistakes by employees that receive an incentive stock option, they exercise it, and then they don't wait that 1 year period, they end up selling it. By waiting that 1 year period after you exercise the position, you can turn the tax from an ordinary income tax, which, back to Kevin's slides, those marginal rates, the different tax brackets, you can turn that tax into a capital gain tax, saving you upwards of 10% in taxes on that transaction. So the incentive stock options really need to be handled with care, with strategy, and a definitive approach to utilizing those. They're not as common, but wow, they can be very lucrative, and they can be much more advantageous for the employee from a tax perspective if it's handled appropriately. Non-qualified stock options are always going to be taxed as income, so you want to be aware. Typically, there's a 10-year period where you have the ability to exercise them, and then they end, they expire, they go away. The grant price versus the price you exercise at, that spread is always going to be taxed as income. So you want to be cognizant of, okay, what is this income doing to the other income that I am experiencing over the course of the year? Does this push me into a higher tax bracket? Is there a strategy that I can counter the taxes associated with this stock option exercise? Essentially, if it's in the money, so to speak, you're granted the shares at 10 and it's trading at 15, you really have a lottery ticket, and it's your choice to cash it in. At what point do you do so? Well, that requires some thoughtful planning. You want to do it prior to expiration, because this is an increase. This is obviously a option that has worked in your favor. Now I can buy shares for $10 even though it's trading at 15. We walk clients through this all the time, but many times there's not a lot of education surrounding these stock options. Some clients have the choice, depending upon the company they work for. Do I take my compensation from an equity comp perspective in restricted stock units or stock options, or a combination of the two? This is another opportunity to look at the overall big picture financial plan and help with that discussion.